Welcome to Investors Hangout. This fortnightly interaction to help you learn more about saving and investing is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, today we're going to be talking about the rising market in the light of shrinking GDP. And to do that with me is Dhirendra Kumar, the CEO of Value Research. Now, Dhirendra, there's a lot in the news right now about shrinking GDP numbers. So, can you shed some light on that? And if you could also explain to our viewers what exactly GDP is?
Yes, GDP, if you look at it in terms of total gross domestic product, which is all the sum total of all the goods and services produced in the country in a defined period. And the way GDP gets reported, it is basically the growth rate. What was earlier and how it has grown. So when you get a 25%, minus 25%, which means compared to the previous period, it has come down by 25%. That's a growth rate. That does not necessarily mean that it is a decline. It could be a decline from the previous period that we were earning or we were producing goods worth 100 and now it has gone down to 75, and which has been a record one in the previous quarter. But that was quite expected. That is, we very well understand that a lot of goods and products or services getting delivered to or created by Indians got completely disrupted. But GDP at best, is an estimation. It is not a precise number. It is not rooted in facts. It is not rooted in facts very precisely. When you get the corporate earnings, say a company is reporting that it earned 550 crore. So it's a very precise number because they would have produced something, they would have sold something, and they would have during that period they would have sent an invoice, not necessarily got the money. So that is the account. There is a degree of precision there. When we look at the mutual fund NAV, there is a very precise thing that market went up by this much, and if you invested X rupees, and today the NAV is X for 1.2x, then there's a precision. You can take that money. GDP is an estimation. It is trying to guess based on surveys, based on ground surveys, and government has a machinery, and there's a full department working on this. I'm told that it's a very loose estimate right now because the kind of disruption that we have seen because of this pandemic, even the acquisition of collecting that information, that machinery was not very effective, or was not working very efficiently. So of course, it is understandable that GDP will go down. It is understandable that it is also linger. We may not make a quick comeback till the routine or the normalcy is restored in people's lives. So unexpected lines, and it is. But there is much more to it, and I don't think we should be entirely basing our thoughts or opinion based on GDP only.
All right. And there's also a disconnect between the market and GDP. So, what is the reason for this? And should investors be worried? And what should they be doing?
Oh yes, there is a big disconnect between our economic outlook and what is going on in the market. Market has been steadily rising. We have seen intermittent correction, but not of a meaningful kind. The correction that we saw in March, after that, a lot of investors were apprehensive, but all those apprehensions were met. Market has only gone up by and large, and we are close to a point where we have recovered the dramatic loss that we saw in the month of March in those 4 or 5 days. But I would say that investors need to understand the basic premise. There is a long-term connect between economic fundamentals and earnings growth of companies. When economy does well, companies do better, and companies do well simply because it's a function of that. Economic growth is also a reflection of the corporate earnings in a reasonable way. So for the market to be going up in a sustainable way or in a manner which is robust, there should be economic resurgence, or the economy should be on a sound footing, and so should the companies. We have seen earnings decline as well, and economic decline if we look at the near term in terms of the GDP numbers. But that is one part of the story. Markets in the short run and the medium term can be guided by a lot of things which is not necessarily fundamental. It could just be the liquidity. It could just be the optimism. It could be greater activity by investors, more investors. It could be lack of option. It could also be relative resetting. And I see that, if the if we don't see an economic turnaround, if we don't see a turnaround in the earnings of companies, then the market will not be sustainable. It will not be able to support, or it will not be able to justify where it is leveled at. But the other factors, they continue to sustain. So I would say that, one should be careful about this, not try and guess where the market is, or how long will this disconnect prevail, or are we poised for a big decline on the market, or also, one has to look at the dynamics of the market. Our markets, of course, the GDP is declining, but we should not forget that when you look at the Sensex and the Nifty, if we think that that is the barometer of the market, then the good part of the earnings of Sensex and Nifty is derived from activities which are not necessarily based in India, and they're still very relevant and growing activity.
Right. So then, if investors can't look at GDP, what are they supposed to look at? And also, how long, like you said, we shouldn't worry about the disconnect between the two. But how long do you estimate it lasting for around? Like, say, if the economy doesn't recover, how long will things go on for like this? Will
Uh,
there be a market crash? Yeah.
the honest answer is that I don't know. I can also guess about when we will make a big comeback, or when things will get back to normalcy. But the fact is that I don't know. Uh, Also, I don't know. I cannot base my opinion based on how long it took for what was the period for which earlier pandemic existed or lingered. All those things are baseless, because the context has changed. Uh, our last experience was 70 years ago, or 90 years ago, or 50 years ago. That's not relevant. The real thing is that, you have to see things around. When you see economic activity returning to normalcy, one is the returning of the economic uh, activity to normalcy. The other is consumer confidence coming back. When we are confident about our job, when we are confident about our future, simply because the premise, right now everybody is in a state of distress, even if they may not be uncomfortable, even if they are not in distress, but we are anticipating distress, because it's a big change, and it's a big change which we have not been used to at all, or we could not imagine.
Right.
So this big surprise that has come our way in our life, it will take time for some people. Uh, my way of looking at it is that I don't know, and I think it is very difficult to guess. It is entirely a function of what you see in your surrounding, and the surrounding can also be very misleading, simply because if you have people around you who are waiting for an opportunity to get back to normalcy, and they will get into the spending mode, and they will get back to the usual way of life very quickly. There are people who will be apprehensive, who will be reluctant, who will take time, and they will be thinking about things differently. They will remain pessimistic, or they will become extremely careful. It entirely depends. So your world will be guided by the kind of people you are around and what you are seeing. But I
Right.
think there is far greater truth in the facts that will come out and which will get collated. I will say that when we see the earnings momentum coming back, when we see first regaining of the earnings, first the companies have to start earning the same amount of money that they did 2 quarters ago. Once we see that, and that could take any time between 3 to 4 quarters at the least. So this is not in your control. I think what we should try and control is what is in our hand, our asset allocation, our division of money, which is meant for short term and medium term and long term, choosing our investments carefully, and not acting in a huff.
Right. Thanks, Dhiren. So we now move on to the questions that our viewers have sent us. And the first one is from Surendra Delia, and he asks, do you expect a big crash in the near future as the economy is in bad shape and likely to get worse? Also, the economy and the indices are not in tandem. So this
Yes,
is
our
something we
earlier
want
discussion
also.
actually has gone about
Yeah,
answering this, but I would say
yeah,
that I agree with all of it. The economy is not in good shape. The companies are, not doing well financially, but what guides the market, as I was saying, that if a lot more people are investing money, Markets may not go down. In fact, we have seen the whole resurgence. Uh, am I expecting a big crash? I will give you the reason behind it. The big crash or the big boom requires emergence or I would say convergence of lot of positives and lot of negatives. There are a lot of there are a lot of negatives today. So if it gets compounded, if we see that the GDP decline is even lower, even higher, then we see that a lot of companies are going under. We see that the earnings are not showing symptoms of any revival. We see there is some situation which actually triggers a lot of investors getting into a state of panic and pulling their money out. A lot of foreigners also, foreign investors also pulling their money out. If those situations arise, which is very difficult to anticipate, convergence of too many bad news or convergence of too many good news leads to a, a a crash or a boom. And if such a thing happens, too many few other bad news which actually causes a panic in the minds of investor, we can have a crash, and it's very difficult to anticipate.
Right. And is the crash likely to be worse than what we saw in March? So, do you
It
think?
entirely depends how investors panic. If a lot of
Right.
domestic investors panic as well as the foreign investors, because the intensity of the crash is entirely a function of news or an action or an event which causes that panic. And if a lot of investors get unnerved, it will cause that. And I would say that uh, that is a possibility which can't be ruled out.
Right. So there is a lot of anticipation of such a crash by investors, and with the market going up, would it be a safe strategy to, take some cash out and keep it aside? And do you think
I would
that's
say
the
that
approach investors should take?
I would say that, with the benefit of hindsight, I can say that it's, last 20, 25 years, I have seen at least 5, 7 occasions when in a brief period of time, 1 day, 2 day, or few days, there has been a big decline. There was one in 2004. The government changed and we saw a 10, 15% decline in the market. The market recovered in 2 days flat. We saw it recently in the month of March. The markets crashed, and in 5 days looked like it was a free fall, and then we have seen the swift recovery. So I would say that don't bank on the crash, but I think devise some mechanism for yourself so that you are able to stay for the long run, which is devise your asset allocation rules, do the rebalancing. And if you do
Yeah.
that, you just might profit from the crash. If you do your asset allocation, if you decide that you should have your 50% money in equity and 50% in debt, and this 50% money in equity will immediately become 20% or 30% if we see a big decline. When you
Yeah.
see the big decline, it will create an opportunity whereby you can move your money from fixed income to equity at that point. So having a rule for yourself, and then you will also not act in a manner that you are getting out of the market and getting into the market with your 100%. That's a very risky strategy, and it is not a bankable one. It may not work.
So now Chandrasekhar, he writes in to ask, considering the current scenario, do you think mid and small caps will be able to deliver in 1 to 2 years? And what is your opinion about it?
When it comes to the future the outlook of mid and small cap or large cap or small cap, it doesn't matter. Good businesses with their dynamics, some configuration will do well. So there will be good small caps, there could be good mid caps, and there will be good large caps, and there will be bad mid caps and bad small caps. So it is entirely it is a matter of selectivity. Businesses with a model whereby we see that there is attraction. In fact, some of the small caps, the good ones will have the potential to become a mid cap, and some of the mid caps will have the potential to become a large cap. We have seen it all the time that good businesses get bigger. It might take longer, and there are good businesses which will remain small. They will remain in the small cap category, so to say, because the definition of the small cap and large cap, mid cap, small cap is the top 100
Right.
companies on a relative basis are large caps, the next 150 are mid caps, and the remaining are small caps. You can remain lower than 250th company in the country, and you could be a great business making a lot of money and growing, and still not get into the top league simply because that's a business design. So I would say that focus on good businesses than and that is what you entrust your money to a fund manager for. In fact, in this, I was looking at the universe of small caps. There are about 4,000 small cap companies listed in the market, and the mutual fund universe of investment is
Mhm.
537 companies only. 537 companies across all mutual fund of all kind, mid cap, small cap, multi cap, and various kinds, the value oriented funds, everything included. The breadth of small cap stocks invested by all mutual fund is 537 companies. So I hope that, but at the same time, one should not forget that small businesses, relatively smaller sized businesses, could be far more vulnerable. But there are businesses, there are small businesses which have done very well, and they're outstanding businesses, and they have been resilient enough. They have existed for 10, 20 years, they have grown, and they remain small.
And then a lot of the small and mid caps have done kind of well over the last couple of months. So is it just part of the broader market recovery, or is it something special to those that market cap?
I think it is reversion to mean. What happened in the
Okay.
small cap and mid cap universe was that it was completely out of favor even before this whole crisis started.
Right.
So if you look at the returns in 2018 or 2019, small caps and mid caps were hammered down, and for understandable reason. They actually the price of some of those companies had gone up substantially, and they were unable to sustain the growth. They were hammered down to a point uh, where they look compelling. So I think it is reversion to mean, and selectivity also matters. We find that the churn in the kind of small caps moving up is very sharp. But I think it is entirely, if you look at, despite the big 30-35% growth in the last, gain in the last 2-3 months, still the
Right.
5-year return of or 3-year return of these small cap funds don't look very impressive.
And with the current situation, that prospects also for a lot of them, not all of them, but for a lot of them would not be so great because of the situation. So shouldn't this reversion to the mean be worrying to investors at all? A little.
It entirely depends. Right now, we are witnessing that there is some kind of regulatory move which might cause some difference. But as I said earlier, small cap, the mortality of companies is always there. They're at greater risk. Some of the companies may not be able to withstand the kind of crisis we are going through, and this is where the selectivity comes in. Uh, and small cap, they always come with their riders in terms of uh, the kind of decline that you see in the kind of volatility in their earnings because they're small. Also,
Mhm.
and that also extends to their stock prices. Uh, I don't know if people still recall, we had few small caps in 2008, and the big decline that we saw at that time, some of the fund actually went down in value by 80%. 80%, if you have 100 rupee invested in those funds and it gets reduced to 20 rupees, it is quite unnerving. So small cap is not meant for everybody. Small cap is meant for somebody who has been through all this and has seen it. Yet, what we find that when you look at 10-year return of many of these funds on a rolling basis, some of these small cap funds still stack at the top. When you look at the 10-year performance of many of the funds, the ones at the top are often the small caps.
Thanks, Ray. So Chandrasekhar, if you're watching, don't worry about the whole category of small and mid caps, but try to focus on buying into good companies, which are likely to see a lot of growth. So the next question that we have here is from Bajresh Patel, and he says we are going through a lot of uncertainty, not just because of COVID, but also due to tension with China and Pakistan. So what should be the investment strategy because of this?
As I keep repeating, and I'll, even at the cost of sounding like a stuck record, I will say that make your plan and stick to it. Work on
Yeah.
a plan and make that plan work. And if you have planned it systematically, and the plan is pretty straightforward, invest your long-term money in equity. If it is a sizable money, then have some asset allocation rules. Asset allocation rule can be pretty straightforward. If you don't have too much of accumulation, be fully invested in equity, you know, the you don't have much to lose. As it becomes meaningful, have at least a third of your money in fixed income or half of your money in fixed income, depending on your age, depending on the scale, or maybe just a third of your money in equity. But have some asset allocation rules. Uh, Rebalance it. because the kind of panic and the kind of fear or excitement that we see in the market periodically will create such opportunity, and you'll be able to benefit from that. Invest in a good fund, a quick diversification. If you keep doing this, we will have all this crisis all through. Market is never going to be very stable. Market is not going to be in a state that it will keep generating 15% return year after year. When we look at these 10-year, 20% annualized return, what these numbers hide is that there will be a year in which the market has gone down by 50%, the market has gone down by 30%, and we have seen such situations where the market has gone up by 100% or 80% in a given year. 2017 was one such year. Market went up so dramatically. So, and all these moves will come when you least expect it. When you have given up on the market, markets will turn around. When you think that the market can't go down, it will crash or it will fall. So don't bank on
Yeah.
the mood of the market. I think what you have in your control, just be entirely guided by that.
So the next question we have here is from Bharat Bhandari, and he asks, is it a viable option to take a top-up home loan for around 10 to 15 lakhs to invest in blue chip stocks for a decade or two, and at the same time enjoy the tax benefit on the additional EMI? My current EMI is 15,000 and my monthly income is 65,000. Today.
Uh, I encourage people to actually have the home loan if you have to borrow money for any asset. Only thing which is justified, unless there is an emergency, one should never
Right.
borrow money. And the only other borrowing should be for a home. But this is sounding like, if you're going to be very comfortable with this, it may not be a bad idea. But because it's a long-term, thing. But generally, it is avoidable because the real problem of borrowing, which is directed in the market, it amounts to borrow money to invest, howsoever long term it be, and even if it fits into your budget. This plan might work out, but I would say that err on the side of caution, because equity investing requires, you will have regret if market goes down by 15% and you have taken this 10 lakh rupees or 15 lakh rupees and invested. You will think that you are paying interest, because a good part of investing is having patience and good temperament. And when you have a sizable borrowing on which you are incurring interest and repayment, you will not be able to stay the course. So I would say avoid.
So the next question we have here is from Kishore, and he asks, what is your view about investing in dynamic bond funds, as the investor need not worry about the duration of the bond?
Yes, that is what the claim is, that the dynamic bond funds are, and the fund manager will take a call, and
Mhm.
some funds have been able to successfully do it. But the real problem is the dynamic bond fund, the kind of flexibility they have. They can take a view that on the interest rate or the credit side, and they can be wrong. And we have seen that in the last 10 years on some of the critical occasions, because most of the big moves that happens even in the fixed income market has been a surprise, and that surprise has caused losses and for investors. So theoretically, dynamic bond fund is a kind of fund which should have made a case for themselves that invest your money in this and the fund manager will take care of it. But many of the fund managers have not been able to prove their credentials in terms of in a full market cycle. So I would say that be wary of that. You have far greater control in terms of the kind of time frame that you have for your fixed income investment, because our downside risk with a fixed income fund is far lower. The fact that you are investing in a fixed income fund is that you're risk averse, you are looking for a predictable return, and even the scale of volatility that comes in a dynamic bond fund and the price that you pay if the fund manager goes wrong, which has been proven in the last 10 years quite often,
Right.
it may not be a desirable option.
Right. So which fund category would be ideal for him instead of dynamic bond funds?
Depends on your investment time frame. It could be a liquid fund, it could be ultra short term fund, or it could be a short term fund, or it could be a corporate debt fund, but corporate debt fund
Right.
of a high quality, and don't move anywhere beyond that, given the kind of outlook that we are seeing. Because right now, many other fund categories will look very rewarding, like the gilt fund or something, but things change. And we see extreme volatility in their return and also decline in value despite having the safety. So I think one has to be far more careful and cautious with the fixed income selection.
So the next question we have here is from Jomi Joseph, and he asks, What is the PE range that one should consider while investing a lump sum in a value fund or an index fund? And also, what other parameters can be used in the case of an index fund?
Uh, at Value Research, when we analyze index fund, and the only thing with that we are focused on is the tracking error and the cost. Uh, Tracking error and cost are the only things, because these funds are not supposed to do better or worse than an index, and lower the tracking error, and lowers the cost. That is the primary thing. When it comes to PE ratio, uh, I don't think investing is that simple. That low P means because low P means very, very attractive, or high P means there could be a risk, because we have come across situations in the market where high P because these are dynamic things. Price P ratio means price over earnings, and if a P looks very high today, but next year the company is able to grow the earnings, that same price earning ratio will look lower. So in a situation where high P gets justified is when companies are able to grow much faster, uh, and that could be the situation. Great companies often command a much higher P, and they do well despite being expensive. So P in isolation is not necessarily a good barometer of something being cheap or expensive.
Right. All right, our next question here is from Biswajit Chakrabarti, and he says, I'll be retiring this month with a corpus of about rupees 75 lakh. What should be my investment strategy to drive an income of rupees 50,000 per month?
Congratulations, Sajid. You'll be getting 75 lakh rupees, which looks like a sizable amount. But the bad news is that it's not good enough. And but I'll tell you why it is not good enough. If you require 50,000 rupees a month, which is 6 lakh rupees a year, this will amount to earning tax-free 8 lakh rupees on your investment, which is not difficult. But in your retirement, you need two things. One is that your investment should be generating enough money to support your income requirement. At the same time, little more return, so that it can also grow a little bit. Because today you require 50,000 rupees, and 2 years from now you might require, with the rising inflation, or inflation will be back at some point in our growing economy, and you might require 55,000 rupee or 60,000 rupee few years from now. Then you require, if your investment returns are the same, then your need for higher capital will be there, and that is the only way you can de-risk yourself, that in your lifetime you don't exhaust the capital that you have. So I don't visualize that. For this, if you are going to consume 8% of the return, which means your investments must generate 10, 12% return, so that the capital also grows. Uh, with that in mind, I have to, and also to in your retirement, you become a little more apprehensive about this, or you don't want your investments to be going up and down very dramatically. So you can't even take very high risk. So my suggestion to you will be, lower your income requirement in the initial few years. Maybe in 1 year or 2 years time, you can increase it again, depending on the health of your investments or the return on your investments. But for your investments to be productive, it should be there. It should be preserved. And so I will have three things. I will have three suggestions for you. One is that lower your income expectation. Maybe if you can somehow manage, or if you have look for any other source of income, if you can reduce it to 35, 40,000 rupees for next 1 or 2 years. The other is that the money that you require the money that you will require to be consumed, or you intend to consume in the next 1 or 2 years, should be entirely invested in fixed income. uh, you will have to take equity risk, and you will have to take that equity risk in a more calibrated way, which means that all the market linked or equity investment, or even if it is in a balanced fund, one is that invest a part of your money in senior citizen savings scheme as your fixed income option, or post office MIP, or a short term bond fund, and remaining money in equity, and the money which will be invested in equity, and that should be about 50 to 60%, because that will only generate the potential of potential to generate higher return to support that income. And if you put a modest part, 30-40% into equity, into fixed income, that will make sure, and a part of it will be kept in short term bond funds, so 1 or 2 years income requirement invested there. you will be saved from the anxiety of your what is happening to your equity market. The money to be invested in equity market should be spread over the next 18 to 36 months, because lowering the risk of catching a market high is very crucial. So three things to do, and not easy thing.
All right. So our last question here is from Sham Sundar, and he asks, what kind of asset allocation between equity and debt would be ideal when investing rupees 1 lakh in the current scenario for a horizon of 1 year?
Investing for next 1 year, you don't need an asset allocation. The only option you have is investing in a fixed income fund.
Yeah. All right. So thanks, Dhiren. And for all those watching, thank you for tuning in, and do continue to send in your questions. And bye for now.